one should look at this entire bouquet of products when it comes to the selection is concerned, right? So that is how something we thought that why not we touch upon this subject matter, which can be a add of value for the participants, right? So that is what the whole theme of the talk is all about. So when you look at these solutions, mutual funds are something which we all are used to it. Then you have alternates, which are portfolio management services and AIFs, which also I'm sure all of you would be aware of it. And from February 25, we had another investment solution in the form of an SIF, which has come into the market, right? Within all these three investment solutions, you will have different types of products. And when you do the summation of all the products, you will find there are a lot of products to deal with it, right? So how one should look at these investment solutions? So a typical lens towards looking at the investment solutions is nothing but the risk and return, right? One might say that large cap versus mid cap. So mid cap is a high risk and a high return. A large cap is a low risk and low return, right? Similar with a small cap, and similar when it comes to flexi cap, large and mid cap, and all of that product bouquet. The only way of looking at it is the large risk return, and that is what we are used to it, right? And now when we progress further and we face with a more number of products and we apply the same lens of risk and return, one fine day we find that the difference between a product A and product B have reached to a situation wherein the difference between the risk and return may be a few basis point. And then you ask a question whether does it make a sense, right? And then someone might say that it's a marketing gimmick or maybe a fund collection kind of a activity that the manufacturers are doing, right? So that is what the situation is. Now, when you look at all these investment solutions from a different lens, then you find a very fresh perspective to look at it, right? And you appreciate that, yeah, this is something which is worthy of it, right? So, how do I see it? Let us take an example of our day-to-day life, right? We go to a shopping and go to a shop to buy something, right? Over there, the price is not the only lens we apply towards selecting a product, right? There are many different aspects we look at it, right? It can be a quality, it can be something which is in fashion, something which is a brand in nature, something which we might have been influenced by some other person, and henceforth we also want to buy it, right? And this goes on and on and on, right? So from that, the price is not the only factor that we look at when it comes to shopping or selecting some items, right? Obviously price is there, but it might be second, third, fourth criteria, or maybe for someone it might not be a criteria. There is only some other aspects which are except price. So when we look at the investment solutions, then can we ask a question to ourselves that whether the risk and return is the only criteria towards selecting a particular product? Then in that case you will be able to find some other aspects also, right? And that is some other aspects that we would like to touch upon. And ultimately, what is the objective these solutions are going to provide? The objective obviously is for everyone is the returns, but at the same time the other aspect is something which is called as an experience, right? Experience is some other aspect. Similarly, same analogy, we go to buy a car. Every car does the job of traveling from point A to point B, right? But there is another aspect called as an experience, which differentiates from the model A to model B, right? So experience is something which is being applied in every industry, and in investment industry, experience is something is not so often spoken about. Although experience matters a lot when it comes to selecting an investment solution, but that is not so spoken about, right? But now when you reach to an industry which has grown so fast, and now it has reached to an 83 lakh crore of an industry as far as the mutual fund is concerned, what could be the way forward? Right? The way forward can be the experience part, which will matter a lot for the investors, right? So from that point of view, one needs to start gets adjusted oneself in terms of how one should look at the solutions in terms of the experience, what kind of an experience they are going to deliver. All the solutions will work hard towards providing the return, but at the same time there is a journey towards attaining that particular return, and that journey is something which we can manage by plugging in an appropriate investment solution, right? So I would say experience is something that is a differentiating factor. Apart from that, the experience is defined by the flexibility of the mandates that this solution offers, right? So when you start with a mutual fund, the mutual fund is a much tighter mandate in terms of flexibility. At the other extreme end, you have alternates which have a highest flexibility of mandate in terms of managing the money, right? And between both of them, you have a SIF which has got a balanced flexibility, right? So what you mean by flexibility of mandate? Flexibility of mandate is nothing but the guardrails which are being defined by the regulator, which are being defined by the offer documents, which defines as to how I should manage the public money. What are the do's and don'ts? And that is nothing but the flexibility of the mandate. So mutual fund has a very tighter mandate, and at the other extreme end, you have a alternates which has an extreme flexible mandate. And in between that, you have a SIF, which has a balanced flexibility, not so tight as compared to MF and not so much flexible as compared to alternates, right? And that is how you have to differentiate these three different solutions in terms of the flexibility of the mandates, right? Now the question will come as to what this flexibility of the mandate brings to the table, right? So from that point of view, uh, as I said, the mutual fund being a much of a tighter mandate, they have a fixed defined allocation of bands, limited flexibility in terms of usage of asset mix, limited usage of derivatives. They are more of a benchmark mandate driven, less scope of a tactical moves, right? These are the key features of a mutual fund, and that defines a very some or the other way the characteristics of a tight mandate, right? So over here, the focus is stability, the focus is simplicity, and the focus is consistency of the outcome, right? So that is how the mutual funds are. Then you have a SIF which has a balanced flexibility, not so tight, not so flexible as compared to, not so much flexible as compared to alternates. Over there, the flexibility in terms of asset allocation, use of derivatives, sector and stock level, tactical calls, risk management tools, and so on and so forth, right? So in this case, the focus is on the flexibility, opportunity, and taking advantage of some tactical opportunities are concerned, right? And finally, you have the alternates which has got a very high flexibility. They have maximum levers that they can pull in terms of managing the portfolio, right? So over there, they have full freedom in terms of asset allocation. They can do concentration. They can highly customize the portfolio as per the investor's goals, right? And that is how the product is all about. So flexibility is something that is a defining factor. What does the flexibility brings to the table? Flexibility brings to the table is nothing but the product which can be more adaptable as per the market conditions, right? So when you have a product which has a higher flexibility of mandates, in that product, the decision making are also much on a higher level, right? At some point of time, the product also becomes complex in nature because flexibility is very high. You can think of how complex the PMS AIFs as a product are, and how simple the mutual fund products are, right? Because mutual fund has a lesser flexibility and alternates has a very higher flexibility. So flexibility also brings to the table bit of a complexity in nature, and complexity is something so at some point of time are not appreciated by the investors, right? So from that point of view, mutual funds are very easy to understand and stay invested as far as the investors are concerned. And the same time, the alternate PMS at some point of time becomes bit of a difficult for someone to understand because of a high flexibility of the mandates that this solution brings to the table, right? So one has to always look at the flexibility, and along with the flexibility, what kind of a pros and cons that comes along with it, right? So the objective is not to select a very high flexible mandate product. The objective is to select what flexibility is suitable for me as an investor, right? And that is what will define the entire experience of the investors as far as the selection of the suitable investment solution is concerned, right? Over here also you can think of an analogy of an F1 car and a sedan car, right? An F1 car has got an extreme level of flexibility in terms of steering capability, in terms of braking capabilities as well, right? But at the same time, F1 car is not so good in terms of experience of traveling into it, right? As compared to a sedan. Sedan is much comfortable, much, it gives a better experience of traveling. But at the same time, it doesn't have a as high flexibility as compared to F1 in terms of steering maneuverability and the braking capability is concerned, right? So flexibility, don't ever confuse yourself that highest flexibility, that means highest return. No. What amount of flexibility is comfortable to my investor is something that we have to sit across and decide that this is the amount of flexibility, sir, it is suitable to a temperament, hence for this product. This flexibility suitable to your temperament, hence for this product for you, right? And that is how one has to think about the flexibility and the experience is concerned, right? So every decision has a trade-off. It is nothing called a free lunch in this world. Everything has a trade-off. You get something, you forgo something, and that is how you have to balance as to how the things are, right? So from that point of view, this is what the things are. So different solutions, different flexibility is something, different experience is something that these investment solutions bring to the table. Within mutual fund also, you will find a wide array of flexibility of the product, right? A typical thematic mutual fund has got a highest amount of flexibility as compared to a flexi cap fund, or maybe as compared to a large cap fund or a mid cap fund or small cap fund, right? So over there also you would see that the experience is much different. At some point of time, although the benchmark of both the product will be similar, right? Say for example, a flexi cap fund will have a benchmark of Nifty 500. At the same time, you will have some XYZ thematic fund with the same benchmark of Nifty 500. But in both of these cases, the outcome will be different in terms of experience. One can have a highest concentration, one can have a highest active share, and other can be benchmark linked to each other, benchmark hugged, right? But the Nifty 500 is common in both of them, right? At a 4 to 5 year, maybe the different return difference might not be similar, might not be so much huge, but the journey of 5 year will be different because of the experience, right? Because of the flexibility of the thematic mutual fund scheme and the flexibility of a typical flexi cap fund, right? And that is how the things are. So mutual fund by design are something which are very simple, which are not so complex, which are more predictable, right? Since the mandate is less flexible, the predictability of the NAV is also much higher as compared to alternate or maybe PMS AIF, right? So from that point of view, the mutual funds are something which participates in the wealth creation, right? On the SIF side, which has got a balanced flexibility, they adapt to the changing market conditions. And PMS and AIF are like a specialized investment solution which pursue the specific investment objectives, right? And that is how the three solutions are, and they are designed to deliver a different kind of an experience to the investors. So over there, the destination and the journey, both of them are a very beautiful thing to understand, right? So destination is wealth creation, but the journey is something which is very much dynamic in nature, right? Destination can be fixed, right? For someone, the wealth creation can be 5 year, 10 year, 15, 20, 30 years timeline. So that is fixed. But the journey of 5, 10, 15 years or 20 years will be very much different in nature, right? So from that point of view, the investment solutions are something which are designed in such a way which can improvise your overall journey, right? Which can improvise your overall journey, which will give you a good experience. And when I'm able to give you a good experience, you are able to stay invested for longer period of time. And when you stay invested for longer period of time, automatically the returns comes, and automatically you get the benefit of compounding, right? So from that again, the experience comes into the picture, right? Look at this chart. All of you are aware of it. The beautiful chart of Sensex from 1979 to 100, of 100 to maybe 78,000 or something, right? So it has created money for all of us, and so on and so forth, right? So in that case, the destination had been more or less fixed in nature in terms of wealth creation, but the journey within this whole destination is different, right? You could see a lot of ups and downs, lot of events, lot of corrections, and so on and so forth, right? So the solutions that are being there in front of us are designed in such a way that the journey becomes much more pleasurable to travel, so that I achieve the ultimate objective of wealth creation, right? So from that, we have to select the appropriate solutions are concerned, right? So you can think of the journey similar to traveling by road from location A to location B, right? So if say for example I'm sitting in Bombay and I want to travel from Bombay to Pune, then the journey of traveling by road is something which will be different for all of us, right? While all of us might be starting from Bombay to Pune, right? So destination is fixed, but the journey can be different, and the journey can be defined by a condition called a pothole kind of a road condition. It can be smooth road kind of a road condition, sharp turns. You have a steep climb also, and you can have a rough terrain also, right? And these are the different type of market conditions also, which we face in our journey of wealth creation, right? Similar to a road condition. Now, within this entire different kind of a journey, how does the investment solution plugs into it, right? So, say for example, in a pothole kind of a road condition, which is similar to a market which is consolidating, which is bit of a volatile, and which is correcting in nature, right? So within the consolidation period, the market is bit of a volatile and corrective in nature. We can think of it like a pothole kind of a road condition. In this kind of a conditions, the investment solutions of a hybrid mutual fund schemes gives a better experience to the investors, right? Then you see a road condition similar to a smooth road. You can think of it like a bull market. Over there, investment solutions from the mutual fund, and that too from large cap, flexi cap, large and mid cap kind of a category, gives a better experience to the investors in terms of capturing the profits or capturing upside of the markets. Then you have a road condition called sharp turns, U-pin kind of a roads, right, which are maybe volatile markets. The reactions are very fast in nature in terms of sectors and themes. In that conditions, a thematic or sectoral funds gives a good experience to the investors. Then you have a road condition of a steep climb, which is a raking bull market. Advance to decline ratio extremely in favor of advanced number of shares. Any number of shares you buy, it goes up, right? No stock picking ability is required. Everyone thinks that we are expert into the market, right? In such kind of a condition, the investment solutions from mutual fund like a multi-cap, mid-cap, and small cap gives a better experience to the investors. And finally, you have a condition called a rough terrain, right? Over there, we don't know what is going to work, right? Market is extremely cloudy. You find sometime copper doing well, silver doing well, gold doing well, and so on and so forth. It's a extremely rough terrain, geopolitical tensions, and there is no hope for good news to come out, and so on and so forth, right? So in that case, a multi-asset kind of a category does well from the mutual fund solution in terms of delivering the overall experience, right? So from that, I'm sure you are able to appreciate as to in which direction we are moving, right? What is the message that we are trying to convey, and how one should think of it when it comes to a different investment solutions, right? So it's ultimately a very fantastic bouquet which has been designed by a regulator, Security Exchange Board of India. There is extremely no intention about creating a confusion. It is only the lens that one needs to apply. And if it is applied in an appropriate way, one will be able to appreciate the entire bouquet of offerings that are there in front of us, right? So that is how the thing are. So with that thought process, how do we create an overlay of an SIF, which is another kind of an investment solution which has come up from February 25 onwards, right? So SIF is something which is a very interesting investment solutions, which has got a balanced flexibility in terms of managing the investors' money, not so tight as compared to mutual fund, but at the same time not so extremely flexible as compared to alternates, PMS and AIF, right? So SIF is something which are an adaptive layer. One has to think of SIF as an adaptive layer, which can be applied over and above the mutual fund, right? So mutual fund will always remain a core product for the investors because mutual funds are easy. They are not complicated. They are more predictable in nature, right? And hence for the investors' comfort level is at the highest level as far as the mutual funds are concerned, right? So from that point of view, we will always keep mutual fund as a core layer, right? And over and above that, you create a layer of an SIF, which is a specialized investment fund in terms of adaptation, right? So mutual fund has got a participation, and over there you apply the layer of SIF, which has got a characteristics of adaptation, right? So participation plus adaptation leads to a much often better or an efficient outcome in terms of overall returns and the experience of the investors are concerned, right? Why SIF are able to adapt themselves? Because of the single reason, that is nothing but the flexibility of the mandates, right? Mutual funds cannot adapt much as compared to SIF because they don't have much of a flexibility to maneuver the market conditions, right? So one has to always think of mutual fund as a participative tool. Market goes up, mutual fund will go up. Market goes down, mutual fund will go down. So it will only participate. Whereas in case of an SIF will adapt to the market conditions, right? And that is how the combination of the participation and the adaptation tool will lead to a better portfolio construction, right? And that is how the things are. And both of them leads to better experience, and better experience leads to a long-term wealth creation for the investors. So as I said, SIF are something which are a gap between a mutual fund and a PMS in terms of the flexibility of the mandates, and that is how the product is all about. In terms of comparative positioning of SIF as compared to mutual funds and the alternates. So from that point of view, SIF is governed by the mutual fund regulations, similar to a similar to what the mutual fund is governed by. Apart from that, the minimum ticket size in case of an SIF is 10 lakhs, and mutual fund is a very retail product in nature. Expense ratios are more or less similar as compared to mutual funds. In derivatives, mutual funds can do only derivatives for hedging purpose and rebalancing, whereas in case of an SIF, the derivatives can be utilized for unhedged strategies as well, over and above the hedging part, right? And add to that, we can do a net short also, subject to a maximum of 25% of the NAV, right? So that are the few things that the SIF can do versus a mutual fund. Apart from that, the nomenclature is also very important thing that one has to be aware of it. In case of a mutual fund, we are used to comparing the schemes with the name as per the names, right? So say for example, if I'm comparing a large cap mutual fund schemes, all the large cap mutual fund scheme will be similar, right? Whereas in case of an SIF, the nomenclature is not the name. We cannot compare the SIF schemes as per the name, right? Over here, the name might be similar, but the comparison should be as per the investment strategy, right? So SIF, because of the flexibility, can have a different investment strategy in spite of the name being same, right? So that is something that one has to be very much aware of it when it comes to comparison of SIF schemes within A to B, right? Or maybe A to C, right? The name might be similar, but if the investment strategy are different, then we are not comparing the apple to apple kind of a thing, right? Which is very much possible in case of a mutual fund, but over here, it is not possible in as far as the SIF is concerned, because the nomenclature is the investment strategy. Whereas in case of a mutual fund, the nomenclature is the scheme name itself. Correct? So that is what the thing is. Uh, in terms of expectations, in terms of overall experience, how the SIF and mutual fund will differ. So as I said, in a mutual funds are a participative tool, or maybe are a participative investment instruments. So what happens is that in a bull market, the mutual funds will outperform in terms of the returns it's concerned, right? Where in case of an SIF will not be able to outperform the market in a bull market, right? Whereas in case of a other kind of market conditions, which are consolidation to range bound to volatile kind of a markets, over there, SIF will be able to deliver a better experience as compared to mutual fund, right? And that is nothing but because of the flexibility of the mandates, right? So when I have a flexibility of the mandates in a range bound to volatile to bear market, I can do lot of things apart from derivatives, which can give a better experience to the investors, right? Whereas in case of a mutual fund, I have very limited ability, right? So from that point of view, mutual funds are ideal for a bull market kind of a environment, right? For rest of the market conditions, SIF adds value in the client's portfolio, right? Henceforth, I said in the beginning that both of these products are not competing with each other. They are complementary product, right? And that is the difference. Competing versus complementary, right? So MF and SIF both are complementary. They are not competing, and henceforth we have to create a layer of SIF over and above the mutual fund, right? So mutual fund will always be 70-80%, and you create an overlay of SIF, right? You cannot do the cannibalizing of mutual fund and SIF scheme, right? Both has to stay together, right? Because in a bull market kind of a condition, if you exclude mutual fund schemes, then in that case the SIF will not fulfill the objective of the investors. Over there, the mutual fund will play the role, right? And if you only keep the mutual fund, then in rest of the market conditions, the handholding of the investors will become extremely important for us, right? Because over there, mutual fund will not be able to adapt the portfolio, right? So in that case, if the SIF will play the role of adaptation in rest of the market conditions, right? And that is how the things are. So seven different kind of a schemes is something that you will see in SIF as per the scheme rationalization. Out of the seven, four are something we are live with as far as ICICI Prudential AMC is concerned. Two from equity oriented SIF, and two from the hybrid oriented SIF is concerned. So four investment strategies are something which we are live with as far as the product offering is concerned. In terms of derivatives, these are the few derivative strategies that an SIF can do right? Arbitrage, covered call, portfolio hedging, and so on and so forth. So every kind of a derivative strategy we can do into SIF, but subject to the exposure limit, right? The exposure in this case cannot go beyond 100, right? So this is not a leverage product. Although we can do naked long, naked short, but in that case, the exposure cannot go beyond 100, right? And that is the limited flexibility which has been taken from the MF, which is good in favor of investors, right? I cannot be a leverage product. SIF is not a leverage product. Although it use unhedged derivative strategy, but it is not a leverage product because the exposure here doesn't go above 100, right? So that works beautifully in favor of the investors because it is not a leverage product. But in spite of that, also the permission is there to do unhedged derivative strategy over there, right? So that is what something you do. We at an ICIF level, I mean at an ICICI Prudential level, we typically stick to first three part of a derivative strategy, which is arbitrage, covered call, and portfolio hedging. Rest of the strategies are something which currently we are not doing. But as we move forward, as we look at the market fundamentals and the factors, we might adopt the different derivative strategy as well, right? So that is how the things are. For us, derivatives is for risk management, and we use derivatives as a strategy combining the fundamentals aspect as well. So fundamentals plus technical is something that we use for designing the derivative strategy as far as the SIF is concerned, right? So that is what it is. In terms of flexibility, so there is a case in point for a covered call, right? In case of a mutual fund, you can do covered call only into Nifty 50 and BSE 30 companies. Whereas in case of an SIF, the covered call can be done into the entire F&O universe stock, right? So you have around 200 plus kind of an F&O, 200 plus kind of a companies which are there into F&O. In case of SIF, I can do covered call in the entire universe. Whereas in MF, only Nifty 50 and BSE 30 Sensex companies only I can do covered call strategy, right? Secondly, in case of a mutual fund, the covered call can be done only to the extent of 30% of the stocks that I hold, right? Whereas in case of an SIF, I can do covered call in the entire 100% of the stocks that I hold, right? And that is what the difference is all about as far as the covered call strategy is concerned. And over and above that, obviously, I can do unhedged derivatives and short also to the extent of 25% of the portfolio. So these are the differentiating points versus the flexibility of usage of derivatives in MF versus an SIF, right? That is what the things are. In terms of suitability, so obviously this is a fund which is suitable for someone who can commit 10 lakhs. Secondly, who has already spent a bit of 3 to 5 years into mutual fund. So this is a product. This is not for first timers. This is a product which someone can look at it for an investor who have graduated the mutual fund investment, right? So graduate mutual fund investors are the one who can look at SIF as an overlay to their existing MF MF investments, right? These are something characteristics which will be a good fit for an investor for whom this is not. For someone who is looking for capital protection, obviously it is not for them. Who is looking for guaranteed returns, I would say not for them. Someone who is coming with a short-term horizon, not for them. And someone who cannot afford 10 lakh rupees, right? So that these are something hygiene factors that one has to keep in mind before putting across the SIF as an investment solutions, right? A quick look on the product bouquet that we have with us. So as I said, we have a 6 different kind of an SIF offerings with us. The key features of investment strategy of ICIF. First, risk adjusted returns, right? So as I said, the objective would be to score high on the risk adjusted returns, lower volatility, protection of downside, and deliver returns independent of the market trends, right? So the objective is to generate returns across the different market conditions. And these are the key features of ICIF as far as the products are concerned. What are the levers that we have? So as I said, this is the product which has got a bit of a higher flexibility as compared to MF, but at the same time, not so highest as compared to alternates also. So it has got a balanced flexibility of investment mandates. So from that point of view, what are those levers that we can utilize to give a better experience to the investors, right? So in that case, first lever is the stock and sector allocations. Over there, we can have a high active share also, and we can be benchmark agnostic. So that is the first lever of alpha generation. Second is obviously in terms of the debt strategies. Derivatives are something which are the additional lever for key alpha generation. And apart from that, participation into the IPOs, QIPs, block deals, special situations, buybacks. These are some of the opportunities that we can utilize as far as the key alpha generation are concerned, right? So these are the things which are there as far as the SIFs are concerned. Quickly to the products part. So first is the asset allocator long short, which is at a first step towards investing, which is on the risk return matrix. It starts with the first product, which is the asset allocator. Over here, the ideal time horizon is 12 months and above. So 1 year plus is something that we look out for in terms of the investment horizon. In this case, the asset allocation is something like 35 to 80% would be equity, 10 to 55 would be debt plus commodities, right? So commodities is something which is optional. I can ignore commodities and I can be fully invested into debt also, right? Whereas in case of a mutual fund, commodities is 10% minimum we have to maintain, right? In this case, we can have the flexibility of having a commodity by merging it with the debt also. So debt plus commodities is 10 to 55 and the balance can be in bits, right? So within these three different asset class, we invest the money as per the in-house model as far as the different asset class are concerned, right? So equity model works first in terms of deciding what kind of a money can be allocated towards the equity out of this 35 to uh, 80% of range. Then we look at the debt model, what is the amount of allocation that a debt should have. And the commodity is something which we look at the third aspect, right? And over and above that, we apply the macro regime overlay to fine tune the allocation between equity, debt, and commodities, right? And this is what the process is as far as the portfolio construction is concerned. Uh, uh, Second is the hybrid long short fund. This is something which is a fund which will have a minimum of 65% into equity and minimum of 25% into debt, right? Within this portfolio, we will create an overlay of derivatives through hedging mechanism. And over there, the net equity level can go as low as minus 7.5 and as high as 75, right? So the gross equity is 65, but with an overlay of derivatives, this gross equity of 65 can be converted into net equity of as low as minus 7.5, right? At the same time, the net equity can go as high as 75 also. And that is how the dynamic management of the net equity exposure will happen, right? So there is a first layer of gross, and over and above that, you apply derivatives to create the net levels. And this net level can be minus 7.5 to 75, again, depending upon the various parameters or factors of the market, right? So over there, what we look at the model, which is the in-house valuation model. This in-house valuation model consists of the price to book value of the market, the currency valuations, the difference between earnings yield and bond yield, the RSI of the market, and overall positioning of the FIIs is concerned, right? So, with a mix of all these factors, the model gives us an indication as to what level of net equity we have to maintain as far as this fund is concerned. Based on that, we dynamically manage the net equity level within the range of minus 7.5 to plus 75, right? So this management happens on a daily basis. We daily manage this net equity level as per the valuation models is concerned, right? And that is how the dynamic nature of this strategy is all about. In terms of returns, so this was the first maiden strategy of ours, which started from February of 26. So almost more than 6 months has gone by. And this is something that it has delivered in terms of experience. The market is almost 4% down from February 26 till date, and the strategy is up by 7%, right? And that is how it has delivered return. In terms of experience, the first part was the downturn from February 26 to 31st of March, which was a start to trough. Over there, the market was down by 13%, whereas the NAV of this SIF was down by only 8%, right? So it captured 58% of the downside. It fell lesser, correct? From there on, we saw the recovery till 3rd of August of 11% in Nifty, whereas in this case, the strategy NAV is up by 15%, right? Just a moment. Sorry. Yeah. Yeah, this one. So in that case, the recovery has been 11, whereas the NAV of this strategy was up by 16%, correct? And in this case, the up capture is 1.43. At the downtime, it captured only 60% of the downside, right? And that is what the adaptability of the SIF is all about. At the time of fall, it fell lesser. And at the time of recovery, it captured more profits or maybe more upside as compared to the broader market, right? And that is how it has done as far as the performance is concerned. Then you have a equity long short fund. Again, over here, it's a flexi cap kind of a fund. But within this flexi cap kind of a fund, the fund can create an overlay of derivatives to dynamically manage the net equity level as well, right? So over here, the fund will maintain the minimum 80% of equity allocation. And if there are headwinds in terms of the economic environment, or maybe if we foresee the volatility into the market, then we can have a lower net equity level as well, right? So that is how this fund will operate in terms of the portfolio construction is concerned, right? So that is how the things are. Again, the fund is flexible in nature. It's a more or less kind of a flexi cap fund with an overlay of derivatives to hedge the overall positions, right? So in this case, the fund can have a different sectors and themes. It can have a different styles. It can have a different allocation towards the market cap, large cap, mid cap, small cap, as per the market conditions. And add to that, derivatives are something which can help the portfolio to adapt to the market conditions, right? And finally, there is a X top 100 long short fund. It is nothing but a mid and small cap. Over here, minimum 65% of the money will be invested into mid and small cap. And over and above that, derivatives is something which we will utilize to enhance the overall returns or maybe the experience of the investors is concerned, right? So in this case, the 65 to 100 will be minimum mid and small cap. The balance can be debt or maybe large cap as far as the allocations is concerned. How do we decide the net equity levels of mid and small cap? Again, the model will help us in terms of deciding the net equity level of mid and small cap. In this case, the parameters are different. Over here, we look at the earnings revision of mid and small cap. Along with that, we look at the market trend, the liquidity of the market, and the currency valuations, right? And that is the parameter that we utilize to decide as to what amount of net equity level we should maintain as far as the small and mid cap exposures are concerned, right? Why the hedging mechanism in mid and small cap? So in this case, this is the Y factor. When you look at this chart, what you could see is that this is the 5-year rolling return of mid and small cap. Correct? Every day, someone would have put money. What is the 5-year return? Right? And this everyday 5-year return chart is there in front of you. Right? Now, over here, what you will find is that although it is a 5-year return chart, the volatility of the 5-year return is as high as monthly return or maybe daily return or maybe 1-year return. Correct? But this is not a 1-year, monthly or daily return chart. This is a 5-year return chart. And that is how the mid and small cap behaves, which none of us are aware of it, right? We only look at the returns. 20%, 25%, 30%, long-term mid and small cap always deliver returns. I agree, it delivers a higher return, but at the same time, the nature of this mid and small cap is sometimes becomes very much difficult to handle for the investors, right? It is the recency bias that we have seen a mid and small cap delivering a euphoric returns to the investors, but it is not true every point of time, right? When you look at the long-term behavioral pattern of mid and small cap, you will find the patches wherein for longer period of time, 5-year returns of mid and small cap are below average. At some point of time, they are single digit. At some point of time, they are negative also for a 5-year period. Then you see a euphoric returns. Then you see again a hibernation period of below average to single digit to negative kind of return, right? And that is how the cyclicality of mid and small cap 5-year return is like, right? So to manage the experience of the investors during such times, the hedging mechanism of mid and small cap is something that we thought of doing it. And that is what the ICIF X Top 100 Long Short Fund is all about, right? So mid and small cap with a hedging mechanism, right? It will regularly try to hedge the mid and small cap exposure as and when the market keeps on going up and up and up, right? And that is how it will work. So in a period wherein the mid and small cap 5-year returns are single digit to below average to negative, over there, this kind of a strategy of hedging mechanism of mid and small cap will deliver a good experience to the investors, right? Whereas in case of a bull market, the primary layer of mid and small cap mutual fund will do better for the investors, right? And that is how we have to think of this particular strategy of X top 100 long short. In terms of returns, so market is up by 1% or so, and the strategy is up by 5%, right? And that is how it has delivered the returns in terms of numbers. In terms of experience, in the initial fall, market was down by 13%, right, from the launch of the strategy to 31st of March. Against that, the strategy was down by 10%, right? So it captured 77% of the downside. From there on, the market recovered almost 16%. Over here, the strategy was up by 16.63 or something, right? So 105 is something the capture ratio is on the upside. And that is how it has managed the experience as far as the top ended, ex-top ended long short is concerned, right? So to summarize, if one has to think of all these four strategy in terms of risk return, so you will have active asset allocator as a low risk kind of a product at the first level. Then you have a hybrid long short fund. Then you have a equity long short fund, and at the extreme end, you have a X top 100 long short fund. And sometime when we come up with a sectoral fund, it will be the most riskier product in terms of offerings, right? And that is how the positioning of these SIF strategies are concerned. In terms of taxation, over a 12-month period, 12.5% will be the tax rate for all of these strategies. Below 12 months, there is an exception of asset allocator fund wherein the taxation would be slab rate, right? For rest of the scheme, below 12 months, the taxation would be 20%, right? So that is how it is. So that is again the beauty of a mutual fund that this platform of SIF has got in terms of the taxation attractiveness as well, correct? That is how the things are. So to summarize, how one can create an overlay of SIF over and above the mutual fund allocation of the investors are concerned. So again, we come to that analogy of a road condition. So the first road condition was a pothole kind of a market, wherein frequent corrections to within a consolidation range. Over there, the hybrid mutual fund schemes did well in terms of delivering experience to the investors. Over there, one can think of introducing hybrid long short fund as an overlay, right? So hybrid long short fund will create an overlay to the existing hybrid mutual fund scheme offering, right? And that is how one has to think of it. Then you have a smooth road kind of a condition. Over there, a large cap, flexi cap, large and mid cap, focused equity deliver a good experience to the investors. In such a situation, the equity long short fund of SIF can be an overlay to the existing large cap, flexi cap, large and mid cap, focused equity MF allocation, right? Then you have a sharp turn kind of an environment wherein sectoral thematic fund does well. In that case, sectoral long short fund can be an overlay. In a steep climbing market, multi cap, mid cap, small cap are the investment solution from mutual fund for better experience. You have an overlay of X top 100 long short fund. And finally, you have a rough terrain kind of an environment wherein a multi-asset mutual fund scheme give a good experience. Over there, you can create an overlay of active asset allocator long short fund, right? And that is how you do a systematic overlay of existing MF holdings. And that is how one has to think of it or move forward as far as this strategy is concerned, right? So why choose ICICI Prudential? So over there, so we have a 30 plus years of experience in managing the investments, a wide team of analysts and fund managers we have. All put together, we cover more than 655 companies put together, spread across 24 plus sectors. So the research strength is our moat as far as the fund house is concerned. Apart from that, we have an experience of managing the derivatives into the mutual fund schemes, right? So around 50,000 crores of the derivatives book is something that we manage at a fund house, right? So we have a huge experience of managing derivatives as far as the capabilities concerned, right? And that is the why part of choosing ICIF as far as the SIF investment solutions are concerned, right? So these are the few of the expertise in terms of managing commodities, the strong fund management team, using various derivative strategies, the capability of investing into innovates, and dynamic management of investment across the asset class, right? So case in point, we are the market leader in the multi-asset mutual fund category, right? With a market share of almost 25%. 84,000 crores is the fund size of ICICI Prudential multi-asset fund, which has the highest market share in terms of total industry AUM, right? Apart from that, in case of a balanced advantage fund, the fund is the number one in terms of AUM, in terms of the capability that we manage. All the hybrid fund put together, we have a market share exceeding 26% in terms of the fresh sales as well as the total AUM is concerned, right? So this is the capability that we have in hybrid. And within hybrid, since we use derivatives a lot, henceforth we would say that we would have the capability of managing the SIF as well, right? So in terms of the positioning of SIF, I would say the traditional investments are your mutual funds. When you apply the overlay of SIF, you optimize your overall returns, right? So from that point of view, if the traditional investment of mutual fund has a point A, which is this one, which has a X amount of risk, correct, and you have a Y amount of returns, right? When you add SIF as an overlay to existing MF, what you do is that you maintain this X amount of risk and the returns can be, sorry, and the returns can be plus plus, this one, right? Y plus. Or you can have a situation wherein you can have a similar return as compared to MF, which is Y, but the risk can be X minus, right? And this is what nothing but the efficiency of the portfolio. You increase the efficiency of the portfolio similar to the mileage of the car without compromising on the CC, right? Without compromising on the engine capability, right? So that is what the SIF is all about when it comes together with the mutual fund holdings, right? So going forward, we are very bullish on this SIF as a category, and we think the new world could be like 50% MF, 30% fixed income, and there would be a space of 20% of SIF as we move forward. So SIF would play a very critical role in the portfolio as we move forward in this new macro regime as we think, right? So with that, I'll stop. Thank you so much for your time, and thanks, Engine, for providing us with this opportunity, right? So yeah, I don't know whether we will take questions or what.
So, would you be available for taking questions? A few of
Yeah.
them, if there are.
Yes. Yeah.
So, if anyone has questions, you can kind of unmute yourself and take up the questions.
Yeah, hi
I have a
Amol,
question.
this is Samir here.
Yeah. Hi, Samir.
Thank you so much for clarifying what SIF is all about. That has actually bring up huge clarity to me. I was very much confused कि SIF काम कैसे करता है. So the
Correct.
point is, SIF, as you said, SIF works in the sideways and on the downside markets, right?
Yeah.
If I've heard it correctly, if I've
Yeah.
understood it correctly, right?
Yes.
It will underperform when the markets are in bull phase.
Correct.
Right?
Correct.
So, from an investor's perspective, ideally, which client should be pitched in the whose portfolio is at what size and to how much percentage we can actually use for this SIF as far as the allocation is concerned.
Yeah. So in that case, I would say the first starting point would be the investors who have already spent 3-5 years into the mutual funds.
The portfolio size I'm talking about. Is there any confined to the portfolio size that
No, we will not apply this in case of an SIF. In case of an alternates, we say that minimum of 2 crores or 3 crores of the portfolio is something that we require. But since SIF starts with a nominal amount of 10 lakhs, I would not put any limit of MF in terms of starting point. The only limit, only condition that I would put is that they should have spent some 3 to 5 years into the mutual fund schemes.
3 to 5 years into mutual funds? Okay.
Yeah.
Okay. Yeah.
Hello.
Thank you.
Hello, Amol sir. Can we think about its aggressive strategy in SIP? Because I want more aggressive funds like small cap, mid cap. So can I consider this SIF X top 100 is suitable for investors? If they
Sir,
are taking if their risk taking capacity is higher.
No, sir. In that case, I would say that in case of an SIF, since they will have some kind of a hedging positions built into the strategy, so by that nature, the capture ratios will not be so high. So from that point of view, the aggression that the investors want from the SIF would not be there.
Okay, sir.
Yeah.
Sir, I have a question.
See,
You mentioned
I'll just sorry, sir. I'll just bring some perspective in this part when it comes to risk part, right? or maybe aggression part is concerned. So over there, what we have seen looking at the market different cycles, the risk and return are something which are not so work in a similar fashion, right? Some we say that high risk is equal to high return, low risk is equal to low return. It doesn't work so. In spite of taking a lot of risk, there are chances that we might not get any return. In spite of fulfilling the conditions of long-term investing, right? Say, for example, someone would have put money in 2008 in BSE Sensex. Currently, almost 18 years has completed. The 18 years return is of only 8.5%, right? So there the risk is taken. The time horizon of 18 years has been spent, but the return is only 8.5 for the investors still at this point of time. So risk and return are something, or aggression is something, has to be subject to what kind of a market conditions are. One cannot be aggressive 365 days. One has to be always conscious of the fact that what kind of a pitch is available to show the aggression and to show the defensiveness, right? September 24 was the time to not to be aggressive. March 31st, 2026 was the time to be aggressive, right? And henceforth, one has to think of aggression and risk return relationship is concerned. So that is how the things are. In this kind of an environment wherein the expectation is of a moderate return as we move forward, the aggression should be to invest into SIP is something that I feel.
Okay, and how much percent we will think about in SIF? Like in mutual fund, small cap, mid cap, we think about 15% plus return we will get in the long term. So how much percentage we will think about in SIF?
Sir,
X top 100, X top 100 category.
Okay, so in X top 100, you can think of like a similar kind of a mid and small cap index returns, but with a lower volatility.
Okay, okay. Thank you, sir.
Yeah.
Sir, I want to ask a question. You mentioned that net exposure in equity in a SIP can go minus 7.5%.
Correct.
I just want to understand how it can go minus 7.5%. As combined exposure will not be more than 100%, right?
Exposure cannot be above 100.
Then equity exposure minus 7.5.
So minus 7.5 will, in that case, will be a net short that the portfolio would have created in such kind of an environment.
Okay.
Subject to 100 rupees not breaching. Subject to not breaching the 100 rupees of exposure.
But then you create a net short of 7.5 negative, 7.5. They are breaching 100, right?
No, sir. Within that 100. Possible.
Okay. Second question is in hybrid category, the taxation is 1 year as a long term. Is it because of the equity exposure is those equities 65 plus, or because they are listed on exchange?
No, because of equity only. Over here, because of equity, in asset allocator, there is an angle of exchange listing. In this case, we have to maintain minimum gross of 65.
Okay. Can we also, like, our mutual fund also allow to list on the exchange? Like the fund where we have 2 years of long term.
No, so in case of a mutual fund, what happens is that you can do redemptions on all the working days. Whereas in case of an SIF, which are hybrid in nature, the redemptions are not all working days.
Okay.
Hence, for the listing provision is given to them.
Okay. Thank you, sir.
Yeah.
Okay, so sir, you said that in this asset allocator long short fund, the time duration is 1 year and above.
Yes.
So if somebody has a money for say 1.5 years, can we put into this fund?
Yes, definitely, sir.
So the probability of getting say subdued returns or negative returns is negated as we speak on this.
Yes, we manage this strategy in a very conservative manner. Henceforth, it has been positioned as a 12-month plus kind of a product.
Okay, so can it give a return of say liquid plus or say maybe FD plus return? What kind of return we can expect out
So
of this
if you can correlate with mutual funds, then in that case, I will bring to the table the category of equity saving fund.
Okay.
So equity saving fund category plus kind of returns.
Okay, equity savings fund percent, that means 7 to 8% kind of return.
It will be, sir, bit on the higher side.
Bit on the higher side. Okay.
Yes.
Fine. With equity taxation, if 1 year is passed.
Yes.
Okay.
Sir, I
High single
compare.
digit, low double digit.
No double digit. I agree. Got
Yes.
it. That's
Yeah.
why I said liquid or I took my second is FD. उसके ऊपर गया ही नहीं, मेरे को पता था वो कंजर्वेटिव अप्रोच ही लेके चल रहे होंगे इसके.
Correct. ठीक है, yeah.
Sir, in mutual fund, I compare it like by scheme name. So how I'm going to compare in SIF, and is tax harvesting is done in SIF or not?
टैक्स हार्वेस्टिंग इन केस ऑफ एन ऐसा है, तो आप कह रहे हो नेगेटिव रिटर्न मिला तो मैं बुक करके उसको मैं कहीं पे क्लेम कर लूँ.
हाँ, like if I am getting like 1,25,000, so we can do tax harvesting in that case.
कर
So
सकते हो, हाँ कर सकते हो, एक्सेप्ट एसेट एलोकेटर फंड,
हाँ,
बाकी सब में कर सकते हैं. इन टर्म्स ऑफ पोर्टफोलियो कंपैरिजन, स्कीम कंपैरिजन, तो यहाँ पे व्हाट यू कैन डू इज दैट द स्कीम विच आर ओल्डर, है ना, 1-2 महीने वाली ट्रैक रिकॉर्ड वाली ऐसे स्कीम मत कंपेयर कीजिए. बट मैं कह रहा हूँ किसी का 6 महीना हो चुका है वैसी कोई स्कीम है, तो उसका रिस्कोमीटर आप देखिए. व्हाट इज द रिस्क रिस्कोमीटर सेइंग, वेदर इट इज हाई रिस्क, मॉडरेट रिस्क, लो रिस्क. तो फ्रॉम दैट यू विल बी एबल टू आइडेंटिफाई कि कौन सी स्कीम कंपेरेबल है. ये हमारे एंजिन का जो सॉफ्टवेयर है ना, हेलो,
yes sir.
हाँ, वहाँ पे रिपोर्ट सेक्शन में जो रिपोर्ट निकालते हो आप, sorry, I'm not propagating, but I have experienced this feature, hence what I'm telling you. तो वहाँ पे जो रिपोर्ट हम लोग निकालते हैं ना, तो वहाँ पे SIF का स्कीम्स भी है. सो और देयर दे आर पुटिंग इन दैट रिस्कोमीटर वाला कॉलम है वहाँ पे एक. मैडम, इफ प्लीज इंटरव्यू ना इफ आई एम गोइंग समवेयर रॉन्ग. तो वहाँ पे
Sure. No
रिस्कोमीटर वाला जो है ना, वहाँ पे लिखते हैं हम लोग मॉडरेट, हाई ऐसे करके. मैडम कुछ हम स्क्रीन पे दिखा सकते हैं आपको.
हाँ.
आप
Just
एक डाउनलोड कर सकते हो स्कीम.
नहीं,
I'll
कहाँ
just
से देखिएगा,
share
जरा
my
बता
screen.
दें तो अच्छा
हाँ
रहेगा.
रिपोर्ट्स, डेली परफॉर्मेंस रिपोर्ट जो आता है ना अपना. हाँ, हाँ देखिए, ये रिस्कोमीटर जो है ना, यहाँ पे से फॉर एग्जांपल हाइब्रिड लॉन्ग शॉट में चले जाइए मैडम. हाँ, अभी आप देखो हाइब्रिड लॉन्ग शॉट नेम से सब सेम है, बट यहाँ पे रिस्कोमीटर हाई मॉडरेट लो करके है. तो जो हाई वाले जो है, हाई वाले रिस्कोमीटर है, दे आर मे बी बैफ प्लस काइंड ऑफ ए स्ट्रेटेजी यू कैन से, जो कंपेरेबल आप कह सकते हो एप्पल टू एप्पल. और मॉडरेट लो जो वाले हैं लोग हैं, वहाँ पे आप आर्बिट्राज प्लस या फिक्स्ड इनकम प्लस इक्विटी सेविंग फंड प्लस ऐसे टाइप की स्ट्रेटेजी कह सकते हो.
Understood sir.
है ना, तो रिस्कोमीटर आप देखिए, वहां से आपको थोड़ा अंदाजा आ जाएगा. ठीक है मैडम, थैंक यू. ओके, एनी अदर क्वेश्चन.
सर एक बार वो जो भी रिस्कोमीटर वाला एक्सेल शीट वापस से ओपन करेंगे प्लीज. हाँ, इसमें अगर अभी अपने देखेंगे तो मैग्नम हाइब्रिड लॉन्ग शॉर्ट जो फंड है उसमें कैटेगराइजेशन किया गया है मॉडरेटली लो. ठीक है. और यहाँ पे अगर 6 मंथ्स का रेट ऑफ रिटर्न देखेंगे तो इट इज कमिंग 2.76, which translates into approximately 5.5% ईयरली. मतलब ये एब्सोल्यूट रिटर्न्स हैं. और अगर इसी के साथ में यहाँ पे अल्टीवा का अगर मैं कंपेयर करता हूँ तो इट इज कमिंग टू 6.14 फॉर द 6 मंथ्स, तो विच इज कमिंग टू 12% CAGR. दोनों का कैटेगराइजेशन जो है मॉडरेटली लो ही है. ठीक है. सो मतलब ये रिटर्न्स फिर एक्स्ट्रा या तो या लोअर, मतलब दोनों में से वाइस वर्सा यू कैन कोट कि किसने इसने ज्यादा क्रिएट किया है या उसने ज्यादा कम क्रिएट किया है, तो वो कैसे इसमें समझ में आएगा हमको कि क्या डिफरेंशिएशन होगा इन दोनों में?
सर इसमें दोनों मॉडरेट लो है, डिफरेंस में इतना वेरिएशन है ना, तो पहले तो कैपेबिलिटी ऑफ द फंड मैनेजर कैन बी डिफरेंट। सेकेंडली और चीज देखनी है तो इसमें स्टैंडर्ड डेविएशन भी आता है थोड़ा। मैडम राइट में जाएंगे तो वॉलिटिलिटी आ जाएगी अपनी। वॉलिटिलिटी, हाँ देखो इसमें वॉलिटिलिटी भी इज ऑलमोस्ट सेम, मे बी दूसरे का ज्यादा है और रिटर्न्स कम है। तो फंड मैनेजर स्किल सेट को आप कह सकते हो कि अच्छी तरीके से मैनेज किया।
ये तो एज अ डिस्ट्रीब्यूटर हाउ वी विल एबल टू डिफरेंशिएट एंड सिलेक्ट द प्रॉपर फंड्स? खाली स्किल सेट तो नॉन, मतलब पैरामीटर, मतलब कोई उसका पैरामीटर नहीं है ना स्किल
हाँ
सेट का खाली, मतलब उसको कैसे हम डिफरेंशिएट कर पाएंगे कि ये फंड सिलेक्ट करना चाहिए कि नहीं करना
सर यहाँ पे
चाहिए?
एक बार आप फंड हाउस से बात करेंगे तो ये लोग बता पाएंगे कि क्या एग्जैक्टली उन्होंने किया कि रिटर्न कम है कि ज्यादा हुआ।
नहीं, इसमें बेसिकली हमने फंड हाउस से जैसे बात करते हैं
हाँ
ना,
हाँ
तो
हाँ
ये स्ट्रेटेजी के अंदर ये बोलते हैं कि हमने नेकेड कॉल लिया हुआ है अल्टीवा ने
हाँ
5% का,
हाँ
5 to 6% का, बट
हाँ
अल्टीवा है वो ज्यादा सेफ प्ले करता है,
हाँ
बट सेफ प्ले करने के साथ में रिटर्न आर्बिट्राज से भी कम हो जाता है। सो
हाँ।
दैट इज मेक्स द डिफरेंस, बिकॉज ये लॉन्ग शॉर्ट पोजीशन जो है बेसिकली इट इज
ओके।
अबव आर्बिट्राज एंड
हाँ
बिलो इक्विटी सेविंग, ऐसा बोल सकते हैं।
करेक्ट।
तो ये जो सिचुएशन है कि बिलो आर्बिट्राज कैसे जा रहा है, वो रीजन मतलब कैसे फाइंड आउट करना चाहिए हमको कि हम सही सिलेक्शन कर पाए?
हाँ पर सर इसमें एक चैलेंज क्या आता है कि वी विल नॉट हैव एन एक्सेस टू द मिड मंथ पोर्टफोलियोज ऐसे सिचुएशन में। तो इन बिटवीन द मंथ क्या क्या चीज़ें होती है वो फंड हाउस से ही पता चलेगी, बिकॉज मंथ एंड पोर्टफोलियो विल नॉट रिफ्लेक्ट व्हाट दे हैव डन विद इन द मंथ।
मैं इसीलिए 6 मंथ्स का ही
हाँ
क्राइटेरिया ले रहा हूँ। आई एम नॉट टेकिंग द 3 मंथ्स एंड 1 मंथ का क्राइटेरिया, आई एम
हाँ तो
जस्ट टेकिंग।
करेक्ट
तो मैं 6 मंथ्स को कोरिलेट कर रहा हूँ क्योंकि लॉन्ग पीरियड होना चाहिए जिससे कि ट्रैक रिकॉर्ड ज्यादा समझ में आए।
करेक्ट करेक्ट करेक्ट।
सो ये एक अगर थोड़ा सा अगर आप कुछ बता सकते हैं इसके बारे में, ऐसा ऐसा कैसे हो सकता है लॉन्ग शॉर्ट पोजीशन में, और
या सो
इसको डिफरेंशिएट कैसे कर
वो तो
सकते हैं अपन?
मिड मंथ का कोई डेरिवेटिव स्ट्रेटेजी रहेगा जो उन्होंने एग्जीक्यूट किया होगा अच्छी तरीके से, बिकॉज ऑफ विच द रिटर्न्स वुड हैव गॉन अप। दैट
ओके,
कैन बी वन ऑफ द रीजन जो मिड मंथ एंड के पोर्टफोलियो में हम लोग वो चीज़ें आइडेंटिफाई नहीं कर पाएंगे।
कैप्चर नहीं कर पाए वो
हाँ
बिकॉज
सर।
क्योंकि तब तक स्क्वायर ऑफ हो गई पोजीशन उसने।
करेक्ट करेक्ट हाँ। सो द फंड हाउस पर्सन वुड बी द आइडियल वन, आई थिंक,
ठीक है,
टू एक्सप्लेन
ठीक,
अस।
ओके, थैंक यू।
जी ठीक है।
Sure. I think majority of the questions have been answered that way. So we
यस
can close the session. I would like to thank you, sir, for hosting today's webinar. It was indeed an informative session. And as you could see, many people were also asking the questions, which shows that attentively they were listening to what you were saying.
या
Thank you for joining the webinar, giving an informative session from Team NGEN.
थैंक्स
Thank you
थैंक्स
so much.
थैंक्स थैंक यू एवरीवन, थैंक्स फॉर पार्टिसिपेटिंग। थैंक्स।